Well, good morning, everybody, and afternoon, depending on your location. My name is James Romero. I am the representative from SecureCare that works with all my different organizations across the nation representing the SecureCare products. So I want to just thank you for attending this webinar here today. I know we're in unusual and unprecedented times, but I know finding and keeping occupied is something we're looking to do, keep up with new trends, new market items, and so SecureCare certainly is something to be a part of and get to know what's available in the marketplace as a new long-term care option that we can present and work with our clients. So just from my standpoint here, I've been involved with long-term care. This is my 12th year working at insurance companies representing different long-term care products. And I believe majority of long-term care products out there are all great and are all beneficial to clients. But over the years, one thing I did feel was there would be nice if there was one plan out there that was just simple, that was easy, not only easy for the clients to understand, but even easy for the producer to be able to understand, feel confident with how the plan structure works, and be able to work with when presenting with clients. And that's where SecureCare fits into this marketplace. It is a very simplistic product. It's easy to work with, so I'll go ahead and discuss how that comes into fruition here with SecureCare as we go through our call, but that's been great. It is a very simple plan. And what's been nice about it is it's been a tool to help get new producers developed into selling long-term care. When you have a plan that's relatively easy to just feel comfortable with, that's great. You get more people involved, more people discussing long-term care. So it's really helped increase sales across the board, whether it's just an agent or an agency, having something that we can now include and add that expanded line of business with long-term care. All right, so what we're going to go through is just a background on the company, make sure everyone understands who SecureCare Financial is, go through the overview and the basics, and then what sets us apart, some sales concepts, and then the underwriting processing experience here. All right. Let's first just kind of take a look at a background about SecureCare Financial. So not a lot of people realize we're the 8th largest insurance company. More common name is Minnesota Life. So SecureCare Financial is the parent company of Minnesota Life, but also 8 other subsidiaries. And we weren't really getting that cross-brand recognition. All the subsidiaries had different names, so you weren't getting that affiliation. So people didn't realize how large of a company we are. So in 2018, we rebranded everything under the SecureCare Financial name so we can start to get that collective recognition. And as you can see, 8th largest company. We have $8.5 billion in assets under management. But if you note our financials, we're an A+ carrier with a 96 Comdex. So you know that Comdex ranking there puts us in elite company from a financial strength standpoint. So very solid when it comes to our financials. This is our 140th year of being in existence. We are a mutual company. So if that helps you give some information on SecureCare Financial, you can tell we've been here a long time and solid when it comes to financials. In terms of long-term care, we've been involved with long-term care since 2005. So we're not new to the market, and 15 years of experience. SecureCare, this is the start of our 4th year of having the SecureCare product. So we've been in the asset-based long-term care space, and this is the start of our 4th year. Now we've had tremendous success so far with our early launch. Our sales have been expanding rapidly due to a couple key features which we'll go through and then now share where our position sits now, which is incredibly strong in the overall asset-based long-term care market. So first, let's just go through a structure so we can understand the functionality of SecureCare. So it's very similar to most asset-based long-term care plans. So we'll take a look at an example of a 62-year-old female if we were doing a single premium of $100,000. All right. So the $100,000 is going to be deposited as a premium into the plan, which first creates the base policy. The base policy is a life insurance component. So the life insurance death benefit, as you can see in his example here, is $111,000. So that $111,000 death benefit is also a full balance available for long-term care purposes. So you can access the death benefit for long-term care over a 2-year benefit period. So that's the base policy. It's the life insurance death benefit, which is also a long-term care pool available over a 2-year benefit period. Included in the plan, which this $100,000 premium covers, is also an extension of benefits rider. This is an additional pool of long-term care benefits that would come into play after the base policy of $111,000 had been used up. So this provides an additional 4 years of long-term care benefits. It's not death benefits, so this $244 is not payable upon death. It is just an additional pool for long-term care. So to get your total long-term care benefit pool up front at day one, you just add the two sums together. You just add the $111,000 benefit pool from the death benefit plus the $244,000 from the extension pool. That gives you your day one long-term care benefit pool of $356,000. So right away from day one, you've leveraged your premium, your $100,000, 3.5 times for long-term care purposes. So the concept here is, for a lot of you who have been involved with long-term care, why do we have a long-term care plan? Well, without a plan, you are vulnerable to all your assets being left to have to cover the long-term care expenses. And if that were to occur, you could quickly drain down a lot of the assets in the portfolio, completely disrupting a retirement plan, an income plan in retirement that people have been working on the greater part of their lives. But by simply repositioning a portion of their premium, we can create leverage. And you can see right away, day one, we create 3.5 times leverage towards long-term care costs. So instead of having to pay all that money out of pocket, you can see right away, day one, it's worth $356,000 towards long-term care expenses. But if they don't ever need long-term care, there's protections in place. So first, let's say they have this plan, they live their entire lives and never need long-term care and pass away. Well, the money doesn't go away that they paid for the plan. The $111,000 would just pay back to the family as a death benefit. So you have the protection in case of death and never needing long-term care. The money would not be lost. It pays back to the family. Or what people really like is this plan offers a full return of premium. So after the 5th policy year of being in force, the policy is eligible for a full return of that $100,000 premium. So if for whatever reason the client needs to surrender the policy, they can get that entire $100,000 back. So there's built-in protections in case they don't use long-term care. There's the death benefit if they don't ever use it and pass away, or they have the full return of premium that they can get that $100,000 back after the 5th policy year. So it really helps from a simplicity standpoint why we should do this, why we should move forward. You consider having a $100,000 premium, what that could do, and what it can leverage to. And if you don't end up needing it for long-term care, you do have the protections in place. Now, that was just day one. This is a 62-year-old female. That $100,000 premium also included inflation. So now we take a look at age 80, so 18 years later. What would that 3% compound inflation look like with the long-term care benefits? You can see the long-term care benefits off the base policy has grown to $190,000. The extension rider long-term care benefit pool has grown to $416,000. And remember, to get your total, you just add those two together. Add the $190 plus the $416. You can see at age 80, your long-term care benefit pool has grown to just over $600,000. So now, around the time where you're most likely to need to use the benefit for long-term care, now you're getting 6 times leverage on your money. That's potentially $600,000 of money you would not have to spend out of your own assets to cover long-term care expenses. And if you never need it, pass away, you get the death benefit of $111,000, or if you need to cancel after the 5th policy year, you have the full return of premium. So that's kind of just a simplistic overview of SecureCare, how it works. Just repositioning, get the leverage with the inflation, don't use it and pass away, death benefit or full return of premium available here. All right, so that was just a single pay option. We have multi-pay options as well. So you can do a single pay, you can do a 5-pay, 7-pay, 10-pay, and then the max we have is a 15-pay. So we do have multiple premium payment options. The long-term care benefit is received on a cash indemnity basis. That, I would say, has been the largest attribute that has led to our success so far. I think people really like the story of cash indemnity, and the majority of the products are still not doing cash indemnity. So we are one of the products that is cash indemnity. So that, I would say, has been the biggest draw to SecureCare so far in our years of having the plan available. There is a reduced paid-up benefit available. What the reduced paid-up benefit is, it's another back-end protection. So let's say a client was doing a multi-pay plan. So for example, they're doing a 10-pay. Well, let's say after 6 years of making payments, something happens with their finances and they need their premiums. They can't pay anymore, but they don't want to necessarily cancel. They just can't afford to make their additional premium payments. Well, instead of canceling, there's an option to do a smaller policy based on the premiums they've already paid, what that would have purchased for them. That way they can still keep some coverage and wouldn't have to cancel in the event they couldn't make any more premium payments. So, of course, we're in a difficult time right now, but this is an example of liquidity. People right now are holding on to valuable assets, valuable cash in case of emergencies, than the unknown that we're on right now. Hopefully, and I believe we'll get through this sooner rather than later. But again, if the things unforeseen that can happen and may not be able to make payments, it's another back-end protection in case of that situation. Protect the consumer for the unknown with this product. So really nice additional feature that people really take comfort with the reduced paid up. Then, of course, we discussed the return of premium. Now, we talked about the return of premium on a single pay, which again, after the 5th policy year is when you can get the money back. But on a multi-pay, it's different. On a multi-pay plan, the return of premium is available after you complete your last payment year. So, for example, if you were to do a 7-pay, after you completed the 7th policy year, then you're eligible for a full return of premium. If you were to do a 10-pay, after you completed the 10th policy year, you're eligible for your full return of premium. So it's pretty easy. It just follows your payment schedule. And the question I get, what if you did need to cancel before you finished paying? Well, you would just get sort of a larger percentage, anywhere between 80 to 90 some odd percent. It just depends on how far along the way you are in your payment cycle there. There is a minimum death benefit. So if you end up using benefits for long-term care and you use up the entire death benefit, there's still a residual death benefit that will always be in place. So it's the lesser of $10,000 or 10% of the face amount, whichever is less. So there's always going to be some sort of a death benefit regardless. So some people refer to it as a burial policy, final expense, just another added feature that's on the policy. Issue ages, minimum is 40, max is 75. The minimum policy amount is a $50,000 death benefit. So $50,000 base policy. You'll have an extension rider in addition to that. And then the max policy is a $750,000 death benefit. And again, you'll have an extension rider on top of that. The elimination period is very unique to SecureCare. So we'll spend a couple minutes on that because it's important to know how this works because, again, it is unlike any other elimination period with other long-term care products in the industry. So because this is cash indemnity, the elimination period does not begin once the insured starts receiving long-term care services. Okay, so again, the elimination period does not begin once the insured starts receiving long-term care services. The reason why it does not begin at that point is because this is cash indemnity, which means they don't ever have to have long-term care services, right? They could have informal care provided by a friend, family member, neighbor, the entire time throughout this process. So in that event, how would you be able to document when services started? So here's how we start the elimination period. It's all doctor-driven. It's all based on the insured's doctor. They dictate to us on our proof of claim form at what point in time the insured required assistance with 2 of the 6 activities of daily living or had severe cognitive impairments. It's all based on when the doctor can confirm to us when this situation took place. So as long as the insured, as we expect they would be in a declined health state, would be visiting their doctors, they're documenting this so they can dictate to us the progress and at what point they reach that qualifying status. So let's say, for example, somebody were to file a claim today for long-term care, and the proof of claim is completed by the doctor, and the doctor confirms they required the assistance, say, 5 months ago. Well, then the elimination period began 5 months ago. So the 90 days would have already been satisfied. Now, we won't retroactive pay in reverse, but we will begin to pay immediately. So we expect the majority of our claims will be able to get their payments essentially immediately, because for those of you familiar with long-term care, it is extremely rare for someone to file a claim on the immediate onset of being in a long-term care situation. Most long-term care situations are the result of a gradual decline in someone's health, and so you have the insured's immediate network, friends, family, helping out to where eventually their health deteriorates to the point where now they feel it's time to access the long-term care benefits. Well, do they know with SecureCare during that time, they're actually completing the elimination period. As long as they're seeing the doctor to have this documented, they're essentially having the elimination period being satisfied. So when it comes time to file the claim, the doctor confirms what point in time they met those requirements, and then we can begin payment immediately if more than 90 days have surpassed. So I really like that about SecureCare. At first, when I was looking to join Securian just over a year ago, I had some reluctancy to a 90-day elimination period, but once it was explained how it works, I thought that was actually very flexible and could be more flexible even compared to a 0-day elimination, because even on a 0-day elimination with reimbursement plans, it doesn't mean you file and get paid immediately. When you file, you still have to provide documentation for an approved licensed caregiver. That has to be approved. Then you have to have services and generate a bill. So they have 30 days that would go by, and then you submit the bill, it's reviewed and approved, and then you get the reimbursement. So that's still not necessarily immediate. Even though it's 0-day, you're not going to be necessarily out of cost. But I like the immediate potential you can get with our elimination period, which we expect in most cases will be already satisfied when filing a claim. So I thought that was very unique and a nice selling point. All right, let's talk about what sets SecureCare apart. That was one example on the elimination period, but here's 5 key items. How do clients receive their benefits? How can they keep up with the rising cost of care? What protections do clients have in place? What are the tax benefits? And what happens if a client travels abroad? So keeping up with the indemnity, that's been, as I mentioned, the biggest draw to receiving benefits. You can see here's 2 columns in comparison to reimbursement and cash indemnity. Now, again, reimbursement still dominates the industry, and it is great. It is still something that's going to get all the coverage you need from a qualified services standpoint. It's just you have to adhere to the guidelines of the policy of what will be covered and what's not. That's all it is. You just have to make sure you adhere to the guidelines, and you will get fully covered for your long-term care needs. So what's nice about cash indemnity, what people are attracted to, is cash indemnity covers everything reimbursement will, plus the added flexibility of not having to adhere to any specific or sort of guideline. You just get your monthly benefit paid to you, and you can choose to spend that money however you want, whether that is on qualified services or informal care services, or even not on long-term care services at all. You can use for personal living expenses, bills, savings, however you want. There's no requirement on how that money is spent. So people, when they hear that story about cash indemnity, they really like the control that they have from a cash indemnity standpoint. It essentially just becomes a tax-free income that's direct deposited into their account each month that they then can choose to spend however they want. So it just sounds a lot simpler and easier from that standpoint when how the policy works. There's no worry. They can spend that money however they want. What we really like about that from a carrier standpoint, and in my position, That is what's helped advisors, new advisors, get into long-term care, because now we made the conversation a lot easier for that advisor to have that discussion about long-term care. Because I would say the biggest, reluctancy advisors would have to getting into long-term care is just not knowing the policy and being able to answer a client's questions. So if the client's going to commit a significant amount of money to a policy, they're absolutely going to have questions about the coverage. And if you can't answer those questions, well, that's going to discourage you from wanting to offer long-term care. SecureCare took that completely off the table with the cash indemnity, because you can have the confidence now to know every question about coverage the client asks, the answer is yes, because essentially everything's covered. All you need to know is how you trigger the benefit, and that's just requiring assistance with 2 of the 6 activities of daily living or have severe cognitive impairment. As long as you know that, once that benefit's triggered, it's just an income from there that they can spend however they want. So any question the client asks about how they can spend that money, you can be confident the answer is yes, because they can spend that money however they want. So real flexible when it comes to that standpoint. One thing I do want to confirm for everybody, we do have a concierge program for claims. So that's not only available on the reimbursement plans. Our plan offers a full concierge service as well that helps you file the claim, helps you understand what type of services are available to you, what type of services based on your insured's health situation, what might be the most beneficial type of care to have, what are some companies in the area. If you need help developing a plan of care, our concierge services can do that for you as well. All included, no charge, it just comes with having a policy with us as well. So again, I really like that standpoint from the cash indemnity. I really like the flexibility that involves. So that's been the biggest draw, and what's helped us grow so quickly in the industry was the cash indemnity combined with a full return of premium. I think that helps a lot of people feel comfortable about presenting long-term care, knowing you're covered by a full return of premium if the client needs to cancel. The really nice story of the cash indemnity. So that's been our biggest draw. That's why in the up until now, our 3 years of having SecureCare, why we've done so well. Now, what's interesting to note with that, we would not show the highest benefits in comparison to our competitors from a premium standpoint. So meaning, let's say you wanted to quote SecureCare, let's say June of 2019. You get a quote for SecureCare and then maybe a couple of other asset-based long-term care products in the industry, and you run the same premium for that customer. Well, the other carriers would have shown higher benefits than SecureCare, but our value proposition would have been the full return of premium plus the story of the cash indemnity, and that story got us a significant amount of sales. So we were already doing very well from that standpoint. Now fast forward to today. We are in an excellent position, which is why so far in 2020 we were on an absolute tear into the year, because now with pricing changes that have been in place with our competitors in the industry, we now offer the highest benefits for your premium, specifically in single pay and majority of 10-pay cases. So now you think about how strong our story was with the cash indemnity and the full return of premium. And again, this full return of premium with our benefits was in comparison to a partial return of premium that our competitors offer. But now we offer the highest benefits for your premium in the industry with offering a full return of premium compared to our competitors that offer a partial return of premium as their best option. And we have the cash indemnity story. So when you hit on those 3 key points, I mean, we were winning in majority of cases that were presented in because of how attractive all 3 of those components were. So like I said, it's a little disappointing we had to have this slowdown right now, because we were having just an astronomical year so far throughout the first 2 months of the year with SecureCare sales. And now we're sort of on pause a bit, a little bit of a slowdown right now as we get through the pandemic that we're dealing with, and hopefully sooner than later we can get back on track. But it was a really good position, and we still are. in that position, I will say this, probably we're getting a lot of questions because our pricing is so good currently, and with the interest rate market and with other companies having to adjust their pricing, are we going to have to do the same? I would say most likely yes. We've had some communication that we would expect we probably will have to adjust our pricing at some point, but as of now, there is no specific plan in place. There is no filing. So for now, we are operating at the continued pricing, with just knowing at some point down the road we will probably have to make some sort of an adjustment. So again, really hoping sooner than later we can get back on track, because it's nice to be part of an incredibly competitive position we stand with our pricing. So what's put us in that position to have the highest benefits is our inflation options. So we're the only carrier that offers 4 inflation options. So we have 3 and 5% at both at both simple and compound. Why that matters, why having 4 choices matters, is the cost for inflation varies for each individual person. It varies on age, gender, premium option, say a single pay or a 10 pay. All of that factors into the price of inflation. Now, you would think 5% compound is going to be your best rate because it offers the highest growth. Well, not necessarily. If the cost for 5% compound is so much that it reduces your initial benefits so low that over the years it doesn't have time to grow, that it may never even match what you would have got, say, on a 3% that was less costly and started out at a much higher initial benefit point. So that's the reason why I would say, it matters on having choices, because for each individual case, we can look to see what is the best rate based on cost versus the potential for growth in realistic years down the road. We use a target age of 80 to see what would get you that best benefit at that point. So a key example is 5% simple. A lot of times that is superior to a 3% compound rate, and right now, I think as everybody knows, 3% compound is the most common rate used with long-term care. However, it doesn't necessarily mean it's going to be the best. In some cases, 5% simple, or even 5% compound on males, believe it or not, is the best rate. So that's another reason why we stand out in pricing in terms of having the highest benefits, is we have different choices we can filter through to allow us to get the best rate, as opposed to just running with 3% compound, like most of our competitors will show with their quotes. So again, just to reiterate, 5% compound is typically the best rate on males. So that puts us in a very competitive position just from a long-term care standpoint. And just to confirm for you, this doesn't mean adding more premium. You'd use the same premium you would on your quote. So say you're using a $100,000 premium among all the competitors, you'd run $100,000 with us, but just select 5% compound for that quote for a male, and you could see the projection at age 80, we would have very strong long-term care benefits with that growth. So another key item that's putting us in a very competitive position. All right, let's recap the projections that we have in place. So you've got, of course, you're going to get guaranteed leverage for long-term care that grows with inflation, death benefit if you don't use it to protect the premium from going away in the case you don't need long-term care, a return of premium that you can get the entire money back, and a reduced paid-up feature. And again, the reduced paid-up means if you need to stop making payments on your policy for whatever reason, you can do a smaller policy based on what the premiums you have already paid would have purchased. To confirm the tax benefits, the benefits are tax-free on the policy up to the IRS per diem. The IRS per diem, this is not something SecureCare sets. This is something the IRS puts in place each year. It's a max amount you can get from an indemnity policy that would be tax-free. So you just want to make sure you are following the per diem limits, but they're pretty high. Right now, it's about $11,000, still $11,500. What you can get out tax-free per month on a cash indemnity policy. So as long as you're taking the per diem amount limit or less, your benefits will always be tax-free. If your policy does offer a monthly benefit that's higher than the per diem limit, you can take that higher amount if you'd like, but just note you'll be taxed on the amount above the per diem limit, or if you can show that you had qualified long-term care expenses that matched the amount you took that was above the per diem limit, then when you do your tax filings, the IRS, then you can still get that amount out tax-free. But for the most part, we expect most people will just take the per diem limit to stay within that guideline. From a premium standpoint, you can get a tax deduction on your premium. So there is a portion of the premium that would be eligible for tax deduction. So when you get a quote for SecureCare, your premium is going to be broken down into 4 categories. So if you look at this section here, policy structure, there's 4 categories here. First, there's what says the face amount. This is the portion of the premium that's the life insurance, and you can see to the right, that's not eligible for tax deduction. But the next items here, the premium for these 3 items, these features, the acceleration for long-term care, extension rider, the inflation protection, the premium for those features are eligible for tax deduction. So that premium is eligible to be deducted. Now, on an individual who itemizes on their taxes, it's going to be difficult to get a tax deduction, so I wouldn't really focus on the individual, but the business owner market, that's where you have the opportunity. So for your individual clients that are small business owners that are set up as a S-Corp, LLC, sole prop, or partnership, they can get a tax deduction. There's no income requirements, but there's an age-related table they must follow. An example is listed to the right. Again, this is put out by the IRS, not SecureCare, and that will dictate their age, what portion of their eligible premium that they can deduct each year. As they age each year, they can move up into different categories that allow them to get a bigger deduction on their premium. And then if it's a C-Corp business owner, it's a little bit more flexible. The age-related table will not come into play. They would just be able to deduct the entire deductible premium. So the premium for this acceleration, the extension, and the long-term care, C-Corp can just deduct that entire premium for that part regardless of age. So a lot more flexible for a C-Corp business owner. We have a lot of supporting material for that. It's been a nice, unique market segment for us. In fact, we have a full presentation available that we have on the business owner market. So if that's something of interest, we do have additional resources in that space. Lastly, what about the international coverage? This is unique. It sets SecureCare apart in the industry. So our product is the only asset-based long-term care plan that allows you to use your extension of benefits rider internationally. So all the other asset-based long-term care plans only allow you to use the base policy internationally. So we're the only carrier that allows you to use your base policy and the extension of benefits rider. So you get your entire benefit pool eligible to use on an international basis. So huge benefit for any of you that work with individuals that any that work with agents that have individual clients that may retire in different countries. SecureCare is going to be a nice long-term care option to present because you won't lose any of your benefit pool that's available to you internationally, and it'll still be cash indemnity. So there's no requirement on the type of care you receive internationally. It'll still be that cash payment that you can spend however you want. So how the international benefit works is what we do is we reduce the monthly benefit in half, and then we extend the benefit pool duration to double the benefit pool duration. So let me explain what I mean by that. Let's say you have your SecureCare policy here in the U.S. It's a 6-year benefit at $8,000 per month. Well, again, we reduced the monthly benefit in half internationally, so it would be a $4,000 benefit per month internationally, but the duration is twice as long. So instead of being a 6-year benefit internationally, it would be a 12-year benefit internationally. That way, guaranteeing you still get the entire benefit pool. So you get the entire benefit pool. It just stretches out over a longer period of time because we reduced the monthly benefit in half, but you still get the entire benefit pool, still cash indemnity, so you can spend that money however you like. So very flexible on how that works for your long-term care benefit. All right, lastly, just wrap up with the underwriting and application submission process. It is on a simplified basis, meaning everybody does a phone interview. So the primary form of underwriting is phone interview. We are on e-app, so you don't complete the part 2 versus writing, asking questions. That's all taken care of in the phone interview. About 70% of applications, the extent of underwriting will just be a phone interview. So majority of underwriting is a phone interview. However, about 30% of applications, the clients will have health conditions that will require some further investigating. And so what we will do for those clients is we will order their medical records, meaning the clients don't really have to do anything on their part. We take care of that. So that where the simplified underwriting comes in is it's just phone interview or potentially getting medical records. There is no exam, no in-person paramed exam, no labs, no EKG. So the client won't have to do anything of that nature. As part of the underwriting, it'll simply just be a phone interview. And then 30% of the time, we'll need to order their medical records, which we take care of for you. Our approval rates is just under 70%, about 69.3% is our current approval rate, so running pretty well there. You can pre-screen anybody ahead of time, so if you have anybody that's has questionable health, we can run that by underwriting just to make sure we're in a good position before moving forward. The underwriting classes, there's no tables. It's either a pass-fail. Everyone through the first 4 tables is a pass to be approved. There's tobacco, non-tobacco, and then there's couples discount or single. To qualify for the couples discount, you have to either be married or whatever state of residence the client is in, whatever the requirements are to get domestic partnership or civil union recognition. We would follow those guidelines to get the couples discounts. Both people do not need to apply to get the couples discount. If one person is applying but they meet the requirements to be considered a couple, then they can get the couples discount on that policy. All right, that wraps up that portion. Before, see if there's any questions, just want to confirm, e-app is essential, especially right now. A lot of carriers, including us, have the majority of their staff working remotely. So it does help. Any digital work we can do certainly helps. We do have e-app access available, and we have seen that being used more often right now to help out, and that's been great. Really appreciate that. So I would say not just with us, but if any insurance company that you're working with right now for any solutions, it is beneficial overall, even for the clients at this point, to work with e-app to help with processing, as there's less people in person to manually process paper applications, and we're certainly in that same situation. So anyone that's working with e-app, we do appreciate that as well. Appreciate everybody's time today, and yeah, hope we can be productive during this time where we're working to get through, and I'm certainly will, and do appreciate you wanting to attend to find out more about SecureCare. So thank you very much.